Hi, I'm John Mark Young, President and Chief Investment Officer of Whitaker-Myers Wealth Managers, and I'd like to welcome you to another installment of the Whitaker-Myers Wealth Managers What We Learned in the Markets This Week video. Remember, our aim is to provide you, our valued clients, with a brief video giving you information that is helpful to your understanding of the markets from a biblical worldview with no financial agenda, which of course makes us uniquely different from the news media in America. This video is for informational purposes only and should not be relied upon to make investment decisions. The clients of Whitaker-Myers Wealth Managers may maintain positions in the securities discussed in today's video, and all opinions discussed are solely those of John Mark Young and not those of Whitaker-Myers Wealth Managers. So let's talk about the four things we learned in the markets this week, starting with point number one. Point number one is, lately it's been back and forth in regards to the market. A little bit positive, a little bit negative. We'll get a positive week, then we'll get a week like this where we see a slightly negative one. The markets needed a pretty rough Friday, actually, to put them in negative territory. We were trending positive for the week at the end of the day, Thursday. And that's exactly what we got on Friday. Friday started down a little bit and then just continually crept down for the rest of the morning and early afternoon. One stat that you may have heard me quote in person or maybe even on this video series is the fact that the market is positive 80% of the time. Now that's annually, and that's annually when you look at it on a calendar year basis, January through December. 80% of the time, stock market's positive, and it's negative about 20% of the time annually. But when considering it on a daily basis, that was annually. When you consider looking at it every single day, 53% of the days are positive and 47% of the days are negative. Think about this year, 2023, as a proxy. If we continue to trade in a range from now until December, and that's not a prediction, just saying we stay flat, we just go up and down from now to December, not a prediction, but for purposes of this hypothetical argument, then it means we pretty much got all our returns from January through July of this year. And no one in January was expecting what we got. No one was predicting the returns we've seen in 2023. So all that to say, please focus on what you can focus on. Things in your control. Stock market is not in your control, and that is your baby step 4. Save 15% or thereabouts of your income. Do it consistently, which is only possible because you presumably did baby step 2, which meant you paid off all your debt using the debt snowball, non-mortgage, and you did baby step 3, you built yourself a solid emergency fund. Essentially, what you did is you built a moat around your personal balance sheet. No debt and an emergency fund. Let's get back to the markets. Each week, we review, as one of our first points, the Atlanta Fed's GDP Now model, which takes real-time economic data as it's released and formulates it into what that means for this quarter's GDP number. The most basic factor for us to understand if we're growing or shrinking as an economy is GDP. If we shrink more than 2 quarters in a row, we're probably in a recession. This week, the number had a lot of inputs that were added and factored in, and that brought that number down to 4.9%. Now, if you remember last week, that was from 5.8, the reading we had last week. And as you can see on your screen, the consensus estimates from Wall Street economists are continuing to have to be risen around GDP because they started way too slow. But the Atlanta Fed's GDP Now model rate is holding steady at 5% in that range, and we're getting closer to the end of the quarter. As we get closer to the end of the quarter, the accuracy of the numbers starts to become greater and greater because there's less data to put into it. So these next few weeks of data will make a big impact, something that we want to watch very closely. Additionally, each week we review the initial claims for unemployment insurance to see if they are giving us a glimpse of people losing their jobs and, keyword here, and not able to find new employment, thus they're being forced to go on to unemployment. This week the number comes in at 220,000 initial claims for unemployment, which is close to last week's number and within its recent range. That still says the labor market in America is extremely strong. And finally, let's look at how the markets performed this week. The S&P 500, which is our proxy for growth and growth in income, but only when taken together, that was negative 0.16% this week. The Russell 2000, which tracks smaller and mid-sized companies or aggressive growth in our Dave Ramsey vernacular, that was negative 0.1 for the week, just barely negative. And the MSCI, which tracks international stocks, that was positive. Yes, I did say positive and meant to say positive. Positive 1.48% for the week, giving diversification the win once again. Point number 2, This week, we received the inflation data for August. As has been the last 12 months, the markets are really watching these reports to ensure we're on track with getting ourselves out of the inflation mess that much of 2022 was mired in. The expectations were that headline inflation, which is everything, all inflation, no stripped out parts, but headline inflation was going to come in at 0.6% increase for the month and a 3.6% increase annually. And additionally, the core numbers were expected to come in at 20 basis points for the month and 4.3% for the year. Now remember, core excludes the volatile parts of CPI. Those volatile parts are deemed food and energy. The numbers were monthly, 0.6% monthly and 3.7% annually for the headline number. So that meant it was 10 basis points, 0.10 higher than expected on the annual number. And then the core numbers came in at 0.3 monthly and 4.3 annually. So the opposite on this one, the monthly number was 0.1% higher than expectations. So roughly in line. For the headline number, the main standout was we saw an increase in gasoline, which is 3.4% of the CPI number and came in 10.6% higher than in July. For the core number, shelter inflation, which is defined as rent and owner's equivalent rent, which owner's equivalent rent is just asking the owner of a home how much they would charge in rent. That rose 50 basis points, 0.50 and 0.40 last month respectively, which translates into a 6% and 4.9% increase annually for rent and owner's equivalent rent. Most economists have been saying for a while now that shelter inflation should decline, but that has been the slowest part of the inflation number to come down. So we're seeing the number continue to come down, but we're still seeing we are a ways away from the Fed's 2% target. And many times that last piece of getting to 2%, going from 3 or 3.5 to 2, that's what's going to take the longest and be the most strenuous part of the process of getting us back to the Fed's 2% number. Point number 3, on Thursday this week, we also got the Producer Price Index, or PPI. In some reports, you might have seen this called wholesale inflation. This is the price producers pay for goods and services, so it's seen as something that is upstream of the U.S. consumer and therefore a leading indicator for CPI, Consumer Price Index, what we just spoke about. So we saw the Producer Price Index jump 0.70% for the month, and economists were expecting 0.40. So that jumped higher. However, the year-over-year number is actually still below the 2% target that the Fed looks at for CPI. It only came in at 1.6%, and that's up from 1.3% last month. The culprit for the PPI taking a jump as well, can you guess it? It's the same as CPI. It's energy prices. Energy prices are what's driving up the PPI as well, because as we've dived into in the last report, we saw energy prices increase over 10% for producers. Every Thursday, we get a national read for U.S. mortgage rates as well. And those came in, look at this, at 7.18, which is down from the 7.23 we saw a few weeks back. So those two reports came out on Thursday. Very interesting, PPI and mortgage rates. And finally, point number 4, the IPO market is back, baby. It's back. Shares of ARM, ARM, surged in its re-debut on the U.S. stock market this week. That stock used to be publicly traded. However, it went private when it was acquired by SoftBank in 2016. Then SoftBank nearly had a deal ready to sell it to NVIDIA. NVIDIA, the stock of the year in 2023. But they had a deal to sell it to NVIDIA in 2020 for a deal that valued ARM at $40 billion. That deal took a lot of heat from regulators. And don't get me started on President Biden's FTC chief, the Trade Commission. She's absolutely the worst FTC chairwoman in the history of the United States. So much so that I won't even name her name on this broadcast. But her last name does sound like Khan, if you're wondering. And that is a very accurate description of her. SoftBank then decided, after that failed, to decide to take ARM public, which happened on Thursday of this week, selling 10% of the company to the public markets at a share price of $51, which now works itself out to a valuation of $54.5 billion. So that deal actually helped them that Biden's FTC share was so terrible. The stock opened hot on Thursday, but took a dive on Friday, as you can see on your screen. Now, you might be asking, who's ARM? They are a UK-based chip manufacturer, hence NVIDIA's interest. that designs chips that go into almost every smartphone in the world, as well as Apple computers, Amazon's data centers, and you'll even find their chips in certain cars. Now, it was started in 1990 as a joint venture between Apple, VLSI Technology, and Acorn Computer. This IPO that we just got this week starts to unfreeze the IPO market that has been present all year. We've just not been getting it. A good sign for the capital markets is getting these IPOs. Next up, Instacart. And we talked about them about 2 weeks ago on this video series. So keep watching our video series because we're going to hit all the new IPOs as they come out and watch them with bated breath to see these new companies, at least new from a public perspective, and how they drive the market's returns going forward. So hopefully this video series was helpful to you in regards to the 4 things we learned in the markets this week. If you appreciated this video, would you do us a favor? You can do us a favor by hitting the like button. The like button helps us with Google and YouTube's algorithms because when you watch the video and you like the video, it tells YouTube and Google that this video series was helpful and informative. As well as if you can hit the subscribe button. The subscribe button allows our content to be pushed out to you as soon as we kick it out, so you get a nice notification on your smartphone, iPad, or computer that we kicked out a new video. As well as if you'd like to schedule a meeting with any of our financial coaches help you in baby steps 1, 2, and 3. They help you get out of debt, stay out of debt, live debt-free. They'd be more than willing to schedule that meeting. Just go to the comment section of this video series and you'll be able to click a link to schedule with them. As well as if you have a child getting ready to go to college, maybe they're a junior and senior in high school, our financial coaches help you not save for college. That's what our financial planners do, but they help you save on the cost of college. And that's an important aspect of going to college is the negotiation. Just like we would never go into a car dealership and say, whatever your price is, give it to me. That's the exact mindset you need to have with college is that price is not the price you want to pay. You want to play the game a little bit with them. Our financial coaches can help you do that. As well as if you're in baby steps 4, 5, and 6, so you're ready to start saving that 15% of your income towards retirement using your company employer plan and a Roth IRA, or maybe you're in baby step 5 and you want to save for college because you probably still need to save a little bit for college. Not a little bit, but some level of wealth for college. They can help you with that, or maybe help you get a plan to pay off your house a little bit sooner so you can move into baby step 7 where we get to live and give like no one else, where the grass feels different. Thanks, my friends, for watching this week's video. We'll see you next week.